What is going on, guys? It is James Lee here from Celestin Capital, and welcome to today's video. Today we are going to dive into the topic of mitigations in forex. Now, I think it's important for us to understand mitigations because this is, especially if you're a smart money trader, this is the backbone of how we trade, right? You know, other people look at the market in terms of, support, resistance, break and retests. Us smart money traders, we look at the market through mitigations, right? We expect it to come to a refined area. That's the only difference between smart money and other techniques, other strategies. The only difference between smart money and other strategies is the refinement that we have within our strategy. As I said before, every strategy works. It just depends on how you use it. Smart money traders smart money is just a refined way of looking at the structure or looking at the market. So let me go ahead and start by explaining what mitigations are. And I first want to start by letting you guys know or asking the question, what do you guys think moves the market? Take a second to think about that. Take a second to think about what do you think moves the market? If your answer was money, then you are correct, right? Money is what moves the market, let's be honest. Because, we have different people involved in the market, which people put their money inside. And that's what moves the market because, the market is just based on the economy and how things are going in the world. And, let's just be honest, money rules the world nowadays. So if you understand that money moves the market, I can go ahead and begin explaining what mitigations are. So now that we understand money moves the market, I want to explain what an order block is. What an order block is, right? And this is going to be, under mitigations, this is going to be an entire range of different topics. Mitigations is an umbrella for different topics of smart money. So within mitigations, I think it's important for me to explain what an order block is. So what exactly is an order block? Let's say we have structure like this, right? We have structure like this. And this is just basic market structure, right? So we see people looking at this as a, support line right here. Retest, they're looking for retest, and their stop loss goes below this low right here. So other retail traders will put their stop loss right here, and that's fine. That's perfectly fine, right? But us smart money traders, we have a refined way of looking at the market. As you can see here, our priority is to refine the structure as much as possible. So instead of getting in right here on this retest right here, what we want to do is we want to get in this zone right here, right? We want to get in around this area, which is why I brought the structure down to here. And then we expect the market to continue in our direction. So again, refinement is what we're all about. We're looking for the refined place. We're looking for damn near the exact place where the market's going to stop and reverse from and continue where we expect it to continue. So with that being said, what is an order block? Let's say we have, again, structure right here. We have this down candle right here, or we have, let me do something like this. I'm going to have to color this in. Let's just say this is a red candle, right? And then we want to, all right, that's fine. Let's say we have something like this, right? We have a down candle, and followed by that down candle, we have a series of up candles. Right? Let's say we have bullish candles. We have bearish candles, and we have bullish candles. And so let's just do this, something like this. That's not what I was trying to do. We have a series of bullish candles. Why isn't this copying? All right, there we go. We have a series of bullish candles, right? So we have this down candle right here, and we have these up candles right here. An order block is basically orders that the banks have put in, right? Orders that the banks have put in. Now, let me explain a little something to you real quick. The market is moved by the composite man. The composite man is basically the person with the most amount of money. And as I explained a little bit before, we have different entities within the market. We have banks, hedge funds, we have retail traders, we have us who are retail traders. And we have all these different entities inside of a market. But who really moves the market? The one with the most amount of money, and that's who we consider the composite man. The composite man is the person with the most amount of money. All right, is the entity with the most amount of money because they are able to push the market in whatever direction they want to. If they want to push the market up, the market's going to go up. If they want to push the market down, the market's going to go down. But here's the thing. The market is a constant fluctuation of ups and downs, right? You know, there's no perfect market structure where it goes like this. You'll see something more like this. Well, within this structure, you'll see something like this, right? You'll see something like this, continuations down to here, breaker structures, fractal breaker structures, and then continuations. You know, you'll see pullbacks and stuff like that. That's what you'll see within an actual market. Now, going back to the composite man. The composite man is able to buy and sell whenever he wants because, again, money is what moves the market. So the composite man is going to use other people's money or tap into a pool of other people's money in order to make his money and move the market, right? So the entire objective of the composite man is to make their money. Now, let me explain what an order block. Now that you know that the composite man is the person with the most amount of money and that person moves the market, let me explain an order block. So, again, in order to move the market, you need money. Here's what happens with order blocks. An order block is basically orders within a candle, a certain candle or a certain area. I guess you can call it, you can just call it a block, so that's what it is. It's basically a candle, but you know, people call it order blocks. Not much of a difference. There is a certain amount of orders within this. So this sell right here, when the composite man pushes price down in order to go up, the reason he's pushing it down is to be able to tap into a pool of liquidity to make his money and then continue making money in the other direction. I don't know if that makes sense. So let's say if you guys watch my liquidity video, I highly suggest you guys watch it. You guys would see that I talked about liquidity in the market, right? And how when, you know, you have retail traders trading support and resistance, you have this area of resistance, you have this area of support. And then I talk about how the market goes in one direction and then reverses and continues in the other direction, right? The reason he's going in this direction is to take out those sells, right? Take out the sell side liquidity. So those people who have their positions like this, and again, there are millions of people doing this, millions of people doing the same thing. So there are millions, potentially billions of dollars in the same place. So if I know there's money in a certain place, I'm going to head into that direction because I know that the market is attracted to money. Money is a magnet for the composite man. Money is the magnet for the composite man. So wherever the money goes, that's where the composite man goes. Wherever money is, the composite man is drawn to it. So the reason the market or the composite man does something like this is to tap into this pool of liquidity. So when you get stopped out, the composite man makes his money, or the more you're in drawdown, the more money the composite man makes. And then he stops you out and then continues in the other direction to continue making money. Because if the composite man continues in this direction, then these buy side liquidity, so we have sell side liquidity right here. So we have these sells and then we have these buyers over here, right? Because, you know, support, resistance, resistance right here, stop loss above the high, whatever. Support right here, or resistance, stop loss above the high, support, stop loss below the low. And you have the market makers go up. Now, if the market continues in this direction, then that means these buyers right here are making money as well. They're still in the positive. But again, composite man is attracted to money. So what is he going to do? He's going to fake one way, tap into that pool of money, and then continue in the other direction to tap into this pool of money. You understand? Money, money, money. Money is the goal. Money is the objective in the market. So wherever the money is, that's where the composite man is headed. All right. So with an order block, let me get back to order blocks. With an order block, oh, let's do this. With an order block, again, same thing I just showed you. The composite man sells in order to buy. So he sells down in order to tap into a pool of money and then continues buying to take out the buy side people, or take out the sell side people, excuse me. So the composite man is going to sell down in order to tap into a pool of money. He's going to use that money to go in the other direction to make even more money. So let me explain this with a better drawing. Hopefully you guys are with me still. Now let me, all right. So as I told you, and we're going to look at this in the live market too. Don't worry. I just want to explain the theory behind order blocks and mitigations and stuff like that. So again, we are, let's say we are in structure like this, right? We're in structure, you know, structure, structure, structure. So we have a sell candle over here, a sell candle, and then we have buys, right? We have buys, right? And then we continue selling. And then you might see something like this. You might see, you know, the market supposedly break structure, right? It looks like it broke structure to the downside. Now it may continue down. But then you see something like this. It continue in the other direction. The reason this is not considered a break of structure, this would be considered a liquidation, right? This will be considered a liquidation. So the composite man is selling into liquidity to grab that liquidity, because the composite man has the most amount of money. Again, he's able to move the market. If the composite man continues buying, he's going to run out of money. But the reason he sold is to tap into a pool of money so that he has even more money to continue in the other direction and make even more money. All right. I hope you guys are with me still. I hope you guys understand where I'm going with this. So this is how it is. Composite man, we look at structure, right? We look at structure. We're looking at structure. So now let me add some numbers to it. So let's say this sell right here, again, composite man, a lot of money. Let's say this is $10 million. $10 million. So he sold into this. This order is worth $10 million. Let's say, I guess, 1,000 lots, which is, I believe, is $10 million. Or 100,000 lots, $10 million. Whatever. It's $10 million worth of an order. So he sold down $10 million. Now, when this composite man buys up, this is in the negative. This 10 million is in the negative, right? So this 10 million, which goes up here, is now worth, let's say, negative 30 million. Negative 30 million. Again, understand the composite man is a man with the most amount of money. He moves the market. So if the composite man moves the market, why would he ever lose? Why would he ever want to lose, right? So this 10 million, which was part of this sell right here, the composite man sold into this 10 million to tap into this pool of liquidity. This sell order has not been closed out, right? Again, same thing with you when you put in, let's say, a buy order and you haven't closed it out. It's still equity, whether it's in the positive or negative. It's still equity. So this is still equity for the composite man. So when that equity, when he buys into the market and he moves the market up, this order is still open. So it goes from $10 million to negative 30 million. Again, because he sold, now the market has bought up and he bought at the same time. So now it's negative 30 million. But at the same time, he's making money off of these orders over here. So let's say he makes, 500K over here. He makes another 750K over here. He makes another, I don't know, 2 million over here, right? So he's making money on this buy, even though his sell is still in the negative, right? So again, if the Composite Man can move the market, why would he ever lose, right? So in order to not lose, the Composite Man has to come back to this, right? The Composite Man has to come back to this area, to this order block, again, order block, to close out the order at break even. So that means he didn't lose on this order, nor did he win. But again, on this buy, he made a ton of money. He made a crap ton of money, right? So again, let me recap. We go from 10 million to negative 30 million within this sell position. This is part of the sell position. But on the buy, he's making money from liquidity that was up here. Say something like this, from liquidity. So people whose stop losses are over here are being taken out with these buys, right? Everyone whose stop losses over here are being taken out with these buys. So as the market continues up, he's taking out the sell side liquidity. So he's making money, which is this right here, 500K, 750K, 2 million, right? But in order to not lose money, so this is a total of, I don't know, let's say he continues to make money. He makes another 5 million, comma. He makes another 5 million, right? So total, he's about, 8 point something million, right? Let's just say 8 million to keep things round. So he's up 8 million. But again, he's up 8 million on the buy. But again, he's still down 30 million because the market pushed up. So in order to combat this 8 million, in order to not lose, the market has to come down and close out the orders that he sold into with this order block right here. Right? You get it? So the market pushes up, comes back down, closes out his orders at break even. So now he's positive 8 million, and this negative 30 million no longer exists because the market came down to close out this $10 million sell, which turned into a 30 million, which came back to close at break even. So all in all, he's up 8 million, right? You see how it works? Again, the market would not be able to make this money, this 8 million, if he didn't sell to tap into this pool of liquidity to generate the money to be able to buy the market up. I hope that's making sense. And it's the same thing the other way around. The market buys up to sell, sell to buy to sell, whatever. Same case with both. If we were to buy up before we sold, you would see a green candle with orders within it that is in the negative as the market goes down. And the market has to come back, close at break even, and then continue down again. And he's up a substantial amount of money. It's 150 mil, 250 billions of dollars potentially. This is nothing compared to what the Composite Man makes. This is just a small fraction, right? He's dealing with hundreds of millions, billions of dollars. I'm just using small numbers to keep it simple. All right? So I hope that makes sense for you guys. Now let's take a look at the live market so I can show you exactly how, or show you exactly how this works. Now let me get rid of these. All right. So let's go ahead. And it doesn't matter what market it is, what forex pair it is, happens every pair, every commodity, right? So this is GCAT, or this is GU actually. It doesn't matter, same thing. So let's take a look. Let's take a look, right? All right, so we see something, an example right over here, right? We see that the market, so let's take a look at this area right here. Let me make this transparent. Let's take a look at this right here, right? Hopefully you can see the box around it. Let me see if I can, yeah. All right, there we go. Let's take a look at this area right here. Focus on this area. So we see structure right here, right? Right? What happens? You see that the market is selling, creating liquidity, creating sell side liquidity, right? Again, if you didn't watch my liquidity video, I highly suggest you watch it, or else this might not make much sense to you. But if you know about liquidity, then you understand we have liquidity right here. We have liquidity right here. We have liquidity right here. The market took out this liquidity with this buy over here, right? Took out this liquidity, so the Composite Man has made money. But all right, let's just follow structure. Liquidity, liquidity, liquidity. The market is currently heading down. But what do we see? We see a buy up. We see the market come over here, right? Create this sell candle, right? Created this sell candle as I showed you before. Let me zoom in a little bit. Right? So we see this down candle, and then what happens right after? We see an impulsive buy to the upside. We see an impulsive bullish break to the upside, right? So what can we expect? We know that there are orders in here that the Composite Man has to close out, or else he's going to stay in the negative. Well, let me not say he has to. There are orders in there that the Composite Man is likely to close out because he's in the negative. Otherwise, he's losing money. Even though he's making money on the buy, he's losing money on this one order, this floating equity that he has that he hasn't closed out. So we are expecting for the Composite Man to come back to this area to close out orders before continuing to the upside. So we see this down candle right here. We see this down candle right here that we expect, again, the Composite Man to come back and mitigate. That's where the word mitigation comes from. Closing out previous orders. Closing out previous orders. Get that in your head. Closing out previous orders, right? Mitigating. Lessening the blow. And we can actually take a look at the definition of mitigation really quickly, just so you guys understand. Meaning the action of reducing the severity, seriousness, or painfulness of something. When the Composite Man is losing money, it's painful to him, right? It is painful to him. No one wants to lose money, right? And if I have the ability to make money, why would I want to lose money, right? So he's mitigating, he's lessening the amount of money he has lost. He's reducing the amount of money he has lost. So we see this impulsive break right after the Composite Man sold into the orders to tap into liquidity, right? So he's in the negative right now. Now what happens? The market pushes up, the market comes back down perfectly right at this order block. Let me get rid of this. Perfectly, let me use this instead. Right at this order block to close out orders. Look how perfect that is. Look how refined that is. To close out this order. Right? To do what? To continue in the direction that we talked about. I hope you guys understand. I hope I'm making sense right now. I hope you guys understand. Mitigations are a powerful tool in the market. Understanding mitigations is very powerful, especially as a smart money trader, right? That's how we get the beautiful RRs, the 1 to 30s, 1 to 40s. Mitigation. We expect the market to come down, tap into here. What happens? Bam. Look at that. 1 to 10. 1 to 10. Just off of this zone alone, 1 to 10. The market sells. The Composite Man sells. Buys into the market, right? His position is still in the negative. He has negative floating equity. So he has to come back down to close out that order at break even, at a zero, at no loss, to continue in the direction and continue making money. Look, 1 to 10, beautiful, right? So I hope that made sense for you guys. We can look at a sell example as well. I don't want to just look at buys and, I don't want you guys to not be versatile or ambidextrous, if that's a word when it comes to the market. All right, let's go. Let's look at this. So in terms of buys, right? What do we see here? Let me box up the zone again. What do we see here? We see the Composite Man, right? Buying into the market. Where's the last up candle? Right over here. Last up candle is this right here, right? When we were over here, we were looking for the last down candle because we're expecting continuation of buys. But when we're here, we're looking for the last up candle because we're looking for a continuation of sells, right? We're looking for the market to close out this buy at break even and continue selling. So the market has this last buy candle. Let's put these lines around it. The market has this last buy candle, which I put these lines around. The market buys, right? He buys and then sells into the buy. The market never came back to close out these orders. We're still selling, right? We're still selling. We're still selling. We're still selling. What happens? The market comes back up, closes out those orders at break even, and then continues bearish. Right? You understand? I hope this makes a lot of sense for you guys. Or if you didn't catch that, you could have caught something else, you know, like this right here. Where's the last buy candle? This is the last buy candle. The market sells, taps into it several times. So you could have had several opportunities to get in on this move and then continue down, right? Last buy candle to continue down, right? You see? Perfect. And if you want to look at the RR, beautiful RR. Beautiful RR, right? It's the simple things that make the biggest difference in the market. The simple things that make the biggest difference. Understanding mitigations is simple, but it's very powerful. Simple but powerful. 1 to 8. Simple but powerful. You know, it's not necessary to make your strategy complex or complicated or, you know, try to be the smartest person in the room. It's not necessary, especially when it comes to trading. It's unnecessary, right? So I hope this mitigations video made sense to you guys. Understand mitigations are just the banks closing out their orders, closing out floating equity that they are in the negative. So if I'm looking for the market to continue for buys, I want to look for down candles, the last down candle, as we saw over here. If I'm looking for the market to continue buying, I'm looking for the last down candle. If I'm looking for the market to continue selling, I'm looking for the last up candle, as we saw right here. So again, I hope this made sense to you guys. If you liked the video, be sure to hit the like button. I hope this provided some kind of value to you guys because, you know, I spent a lot of time researching and just understanding, learning mitigations, and, you know, I wanna see that you guys are understanding what I'm talking about. You know, I don't want my research to go in vain. So again, if you like the video, be sure to hit the like button. If you want to stay tuned for more content, as I told you, I'm going to continue to provide to you guys. Be sure to subscribe and turn post notifications on. If you guys saw my last video about the FTMO, I am currently in an FTMO challenge, but I haven't taken a trade yet. As I told you in the video, I haven't taken a trade yet. I'm going to make an entire series where I document from beginning to end me taking the FTMO challenge, passing the challenge, passing the verification, and becoming a fully funded FTMO trader. So if you guys want to stay tuned for that, be sure to subscribe and turn on post notifications. And I hope you guys have a great week of trading this coming week. And make sure you're back testing, make sure you're studying, make sure you guys are constantly in the market and constantly refining your strategy. Again, never stop learning, never settle. Be great. Peace out, guys.